Hello, Andrew Faldy with a quick update on the strategy set research and development. Let's see, where should I start? Showing you something new, I guess. Let's zoom in on this guy. Alright, so this is all the systems plugged in so far, which are very simple, very basic. Actually, systems I probably would not have expected to do well, and ones that probably are not going to be part of the final solution, is my guess. The reason for doing that is it was quick to get new data from a simple backtest and plug in to prove the concept of simple strategies combined to create a single good portfolio equity curve. So these are all the systems plugged into one. You can see we have one here that's just very underperforming. Let me just check what that one is. So that's a short monthly put in the money, not very profitable. I have to double check that. I think that's what that one is. So that's just this one that's not very profitable, but it happened to have an inverse relationship with the trade that it was offsetting. So you can see here where this bearish trade runs up, this one draws down a little bit. When this one draws down, it came up a little bit. So it offset it some, but the net result wasn't very attractive. So this was an ineffective hedge because it wasn't a profitable strategy by itself, but it did smooth the equity curve of a higher performing strategy, so it had value to it. And I had several people ask me after showing some of that information initially, saying, is it, that makes sense to combine something that maybe it doesn't make any money or even loses money, but if it offsets the risk in another strategy, could be a good relationship. My response to those emails was typically that yes, it creates smoother returns, but there's enough other things that work by themselves and create the smoother result. So that's what this has been, is taking this hedge that wasn't effective, adding one that was more effective, and that's this one, and then one that was even more effective, and then the one that was the most effective. And all of these are bullish. Orange line is a bearish strategy. All the other lines are bullish. Ignore the blue. I'll tell you the thicker blue line here. I'll tell you about that in a minute. But the yellow, gray, darker blue right here, and green. These are all bullish trades, and this orange one's a bearish trade. So every one of these offsets the orange trade, the bearish trade, the bear butterfly, but using the one that's more profitable is probably going to be more effective than using one that breaks even. So let's go look at what that looks like here. Okay, so here's the different combinations. The first one here that's taking the profitable bearish strategy, adding the unprofitable bullish hedge, and you can see that it is smoother returns than this orange line by itself, but you have to take half your position to be just a hedge, so you have this very shallow slope. And what we're looking for, and this is the concept I keep trying to make clear, is it's very simple components, this portfolio concept, but the ultimate goal is two things: smooth returns, but also steep returns. It is not difficult to come up with smooth returns. You can do that by selling 2 delta puts, 20 days expiration, and let them expire. You'll have very smooth returns, but it will not be steep. The only way to make them steep at that point is to then take excessive leverage, which means now you're exposing it to higher risk. So I'm looking for not increasing the risk, increasing the smoothness, and increasing the steepness. It's not ultra complicated. We just have to plug in a few of the good components, things that have edge, things that offset each other, diversifying them to reduce random results to create that net equity curve. So then I took one that was a bullish trade that was moderately profitable against the bearish, and that's where you get the blue line. Took one that was even more profitable against the bearish line, and that was the gray line. And then we have this yellow one. Now, part of the reason the yellow one's better than the gray is actually just because there was more data. So these two are actually very similar to each other. This one is in the rut bullish trade against the bearish SPX trade, and this is a SPX short put against the bearish butterfly weekly. So this one came out to be, and you see the actual drawdowns are not much bigger and actually I believe they are less. I'll go look at that data in a minute. Drawdowns aren't any bigger, and the steepness is greater. So that is an effective strategy, and we're only combining two components with this. Very, very simple. A butterfly, a weekly contracts, a short put combined with it. Very simple. And that is combining this orange curve and this green curve, which perform at different times. So you can see here in 2013 the market was very bullish. The bearish strategy took a drawdown. The bullish strategy ran up. But you can see, because it's designed to handle itself, the steepness of the decline is not as steep as this one goes up, because this one's designed to do best in bullish markets. This one's designed to do best in bearish markets, but control their risk independently. This one has premium decay, and you collect premium so that even if the market doesn't go anywhere, it goes against you a little bit, you still collect premium to offset your risk. This one is you have defined risk in the cost of the spread, which is typically less than your potential profit in a butterfly, which we won't get into details on that, but this one controls its own risk. Here you combine them together, and during that period, let me see if I can line it up here, you can see that your combined goes flat and actually has a slight drift up because the bullish strategy outperformed the bearish loss. So you see that works well together. You have these occasional circumstances where they both take a hit at the same time, and that's where further diversification will help you with that. See if there's anything else on here. Here's what I wanted to show. These are same thing. This is just coming in and looking only at those two together and the combination together. So this is the bull strategy, this is the bear strategy, this is the combination. You can see that the performance of when one does better than the other, relatively random. We'll just assume it's random. I do believe you can anticipate that and use trend signals to weight these things, but that's going to come in future versions. But at this point, we're just looking at the fact that if just holding a constant, unbiased opinion on market direction, but having a good bullish strategy and a good bearish strategy separately managed, these have different expirations, different management points, very, very simple management, different holding durations, etc., then your net equity curve is smoother when you combine those two together, as long as they both have some edge and some positive drift to them. A little bit of positive drift plus diversification typically is going to show you a smoother result. I'll show you that. This is kind of the practical example, and I'm going to show you a theoretical way of looking at that using completely random information. So though it's in theory, the fact that I pull in random information makes it makes us see many different data points, and we cannot curve fit the information because it's completely random. So that's that. I don't think there's anything else I want to show you in here. So I'm just plugging in more things as I get them. So we're up to strategy E, A through E, and combining those, seeing which ones look nice together. Oh, there's this one that I told you to ignore earlier that we will now look at. This was the just everything combined. So here's all of the different crazy lines. Some people call them spaghetti lines, spaghetti plots. And this is if you just combine them all to reduce the randomness, and that's actually several bullish strategies plus one bearish strategy creates that. That was just for my own intellectual curiosity to see what happened there. So here's some fun theory. I won't spend too much time on this, but I did want to show it. This is so I have 10. Make sure I got the same thing here. Yep, okay, so I have these 10 systems, right? Yeah, 10. 10 systems completely randomly generating trade data. And I go all the way down, we have 1,000 random data points all the way down here at the bottom. And these are literally random because I use a calculation in Excel called random between, and then you have to give it a range. And what I'm doing is I'm showing it giving it a slight edge, not a lot of edge. The range of your trading can be anywhere from losing $100 to making $120. So it's just a slight edge to the upside here. And repeated all the way down. These are accumulating, so it's adding in the previous trade data. That's why you see these 204. That's just accumulating. Even though that's bigger than the max loss, it's just accumulating these losses together to get to that point. So I do that 1,000 times, and then I did those 1,000 iterations 10 times. So we have 10,000 data points plotted here with completely random information with a slight drift. Remember, we're looking at drift plus diversification should equal smoothness when you combine them. That's the theory, that's the concept. So here is those 10 1,000 plot, 1,000 data points, each times 10, 10,000 trades, randomly generated with a little positive drift, and you can see they're all over the place. And yes, it would be nice to say, well, this is the best one, and that's the one I would have picked. Well, I wish that was the case, but I don't know. Some underperform, some do well at the beginning, and then do poorly later, and it's all completely random. It literally is random calculations just with a positive drift. So we take those, and then on the left we have that all of that information combined as a single. So we're just taking the average as if you selected 10% allocation to each of these 10 systems, and this is the net result. So we see all of this messy information turns into a smooth line. So that's just one example. Well, the cool part about this is I can, if you have this information and you plug this little formula in random between the two values, and you can see it's referencing this, so I can actually change these values to give it less or more edge. And then I can press F9, and every time I hit F9, it redoes the entire spreadsheet, redoes the random values. So you can see now the random plots are all over the place, completely different numbers. So here's the gray ones on top. I'm going to hit F9, see where it shows up. So now it's in the middle. It's on top again. It's in the middle. Now it's at the bottom. And you can see every time I hit F9, the 10 sets of equity curves completely change. Here's a very spread out, something underperforming, something way overperforming. But what you see doesn't change very much is when you combine them. So positive drift in multiple systems, picking the right system, picking which one's going to work, that's probably not the best solution. But when you combine them, you add some diversification. The net result, I keep doing that. I always hit F5 instead of F9. So I'm going to have to wait for this to come up. Get that to go away. And then I'll hit F9. I'm going to do it a bunch of times in a row. And you can see the system on the left, the combined, the average system, is consistently smoother than the individual lines on the right. So that's some nice theory. So what's interesting is now I'm going to take the edge down. And I'm only going to give it a 10-point edge. So lose 100 or all the way up to make 100. And it's not just one or the other. It's anything in between. So you can see across the top all of the different values. You see a 33, a minus 100, a 79, a 12, minus 89, etc. It's any value between these two. So all I'm doing is adding an extra 10 potential points for your biggest win. Very, very small edge in this system here. And what you're going to see is that's going to turn these, each individual system, into very sloppy, messy, completely not losing its cluster, losing its positive drift, losing its edge. So I'm going to start flipping through these, and you're going to see you're going to even have some systems now that are losing at the end of the curve. So here that light blue one at the end is break even. You have one that had a big drawdown in the middle there. So I'm right now just focusing on the right side. You can see that the scatter plots on the right are just all over the place. But what happens on the left is we stay relatively smooth because we still have some drift. The smallest amount of drift plus some diversification is going to create the smoother result. So this is using random information. Every time I'm pressing this, we get a new set of 10,000 data points. And so we've probably looked at hundreds of thousands of data points at this point already, and seeing how this big mess on the right, because they all have a little positive drift, when you combine them, you get a good net result. Now we're going to have a little fun. And we're actually going to look at this, and I'm going to compound it. I don't need that one. So I come down to this one, and you just add the previous result, and you pull that out. So now we have this slight edge that creates some consistency over here, and then you move into compounding, reinvesting your profits. And this is just for fun to see, but the smoothness that comes out of that is remarkable. So I'm just going to press this 10 or 15 times here and just show you that reinvesting gain, any type of positive drift with a little diversification, creates a nice compoundable equity curve, small drift. We see somewhere around 5 points, or a 5% edge to the upside, is about the cutoff point in this scenario, and you're going to see that this is going to get, on the right side, it's going to get even worse. I hit the F5 again. Okay, so I'm going to hit F9 now, and you're going to see on the right side they get even messier, where there's a lot more strategies that are going to move into a loss because there's just not enough edge for all of them to come out on top. But what you can see on the left side is we stay very smooth yet again with that compounding return. Only with that 5 extra points, minus 100 up to 105, tiny, tiny positive drift, combined, diversified, compounded, excellent results. So I'm going to remove this compounding, kind of gets to a kind of a stable value that we can look at and see. Just with that little extra edge, you can see that the net results get a little choppier on the left, but a little bit of positive drift plus diversification, and we get a nice combined equity curve. So I'm going to bring this back over here, the strategy set, and say, doesn't this look familiar now? Coming back and looking at these individual systems. Okay, that was all theory. Now I'm going to show you backtesting, which is still theory, but we're using real market information. We use these different systems. Some are correlated, some are not, but they have a positive drift. One doesn't. One has a lot of positive drift. Some could say that's just market conditions. It doesn't matter. There's positive drift here. There's a little flat over here, but overall they have positive drift. And then when you combine positive drift with the diversification, the net result is smooth. And these are not hand-picked to create that. It is the theory and practice coming together. And then my application in trading, doing this, has seen this positive results comparing to as if I had not in other accounts. Volatility is reduced by using this diversification, using a few different systems. So the theory and the practice, the analytics, are all coming back looking good. That strategy set and these concepts are very valuable and very important to consider. And I'm going to come back in the next video and kind of challenge the idea of symmetrical trading, things that look good on a risk graph, things that seem to make sense from a risk-reward perspective because it's visual and it's easy to understand, and kind of challenge that and say, let's split these up and turn them into individual trades and really see how we can create a little more diversification inside of just one simple traditional configuration of an options trading strategy. So, and all of these applications are can be used in other types of markets, so equities, futures, currencies, etc. And I really think the ultimate solution is to include all of those different things into a single portfolio, and even getting beyond that, to include completely unrelated non-security investments and strategies as well, is just another way to add more layers with positive drift that perform at different times and create a smooth overall equity curve for your total investment portfolio. So that's it. This video went a little longer than I thought, so I'm going to cut it off. And thanks for watching. If you made it all the way to the end, I appreciate your patience, and I hope you find this somewhat interesting. I look forward to hearing from you, your feedback, ideas, and concepts moving forward, and I look forward to sharing more information with you. Thanks a lot.